What happened this week? Is labor market weakness growing? What's happening with construction spending? And are economic measures expanding or contracting? Let's take a look. Before we begin, remember to like this video and subscribe for more economic updates. The week's biggest news was announced on Friday when the Labor Department reported that the economy added fewer jobs than expected in August, providing more evidence that genuine slack is building in the labor market. According to the numbers, non-farm payrolls increased by 142,000 last month. That's up from a downwardly revised 89,000 jobs added in July, but below the 155,000 jobs projected by economists. As for the actual unemployment rate, that fell to 4.2%, in line with estimates. Not only did the headline number come in below projections, but the downward revisions made to both the June and July estimates were substantial. The Labor Department cut the original jobs number for July by 25,000, while June's initial estimate was reduced by 61,000. In his assessment of the data, Dan North, senior economist for North America at Alliance Trade, lamented, "I don't like this a whole lot. It's not a disaster, but it's below expectations on the headline, and what really bothers me is the revisions. This is certainly going the wrong way." Still more evidence of a cooling jobs market emerged this week in the form of the JOLTS report. The report, which was released on Wednesday by the Labor Department, showed that job openings in July fell for the second straight month to 7.67 million from a downwardly revised 7.91 million in June. The July total marks the lowest number of openings in 3.5 years, landing well below the 8.1 million job openings projected by economists. Right now, job openings are running about 36% below their peak reached in March 2022. At that time, there were more than 2 openings for every unemployed person. Now that ratio is down by nearly half. The week's jobs data seemed to not only reinforce the likelihood of a rate cut later this month, but also raise the prospects that the size of the decrease could be as much as 50 basis points. A week ago, markets had pegged the chances of a half-point cut at 30%. Now it's up to 40%. In other news this week, the Census Bureau reported on Tuesday that construction spending in July changed by 0.3 of a percentage point, but not in the direction that economists projected. Instead of climbing 0.3 of a point month over month, spending fell by that percentage, dropping to a seasonally adjusted annual rate of $2.612 trillion. Residential construction fell in July. Multifamily residential construction sank 0.4 of a point, while construction of single-family homes dropped by nearly 2%. Analysts attribute the disappointing results to the springtime jump in mortgage rates that served to put downward pressure on home building and sales. There was a bit of a silver lining to the report. The estimates for May and June were revised upward, with June now coming in flat rather than down 0.3 of a point as initially reported. On Tuesday, the Institute for Supply Management checked in with the first of 2 economic measures this week when it reported that its Manufacturing Purchasing Managers Index for August increased to 47.2 from 46.8 in July. Despite the increase, the index once again came in below the key level of 50 that distinguishes contraction from expansion in the nation's manufacturing sector. That now makes the 21st time in the last 22 months the index has shown contraction. Persistent demand weakness remains a principal culprit of manufacturing sluggishness. In a statement, Timothy Fiore, chair of the ISM Manufacturing Business Survey Committee, suggested that demand remained anemic because companies are unwilling to invest during a prevailing climate of higher rates and election uncertainty. Then on Thursday, ISM was back to report better news from the economy's services sector. revealing that its services PMI rose slightly in August to 51.5 from 51.4 in July. Although just a modest increase, what makes the August reading notable is that economists were expecting the index to decline by 0.4 of a point. Last month's result marks the sixth time this year the metric has indicated expansion in the sector. Still, services PMI has struggled somewhat in recent months to stay above 50 and in expansion territory. Among the component measures of the index that declined last month is the employment index, which dropped from 51.1 in July to 50.2 in August, just slightly above contraction. That's it for now. Make sure to join us again on Monday when we tell you what's happening next week. This is Devlin Steele for Augusta Precious Metals, signing out.